All right, guys, Netflix just reported. So we didn't even see the report yet, and then we just pulled it up in our software, and it was down 10% after hours automatically. So we're like, oh my God, they must have missed big. They didn't. On earnings per share, they actually beat by a penny, $2.88 a share versus $2.87. Revenue did miss slightly, $8.16 billion versus $8.18. But net new subscribers, they were expecting 2.4 million. They got 1.7.
Yeah, that's bad.
That's probably why. Yeah, exactly, Mo. That's really bad.
Yeah.
So we're confirming these numbers because we're confirming the numbers, but in the meantime, Netflix is still down 10.5%, below 300. It hasn't been, I mean, it's been on a pretty big tear here for the last year. The 52-week low was May 12th, a little under a year ago at 162. 52-week high was weeks before that. How can we have a 52-week high? What am I missing here? Okay, so anyhow, all-time high of $700.99. Guys, this is a company made $4.5 billion, free cash flow only $1.6 billion, and a 5-year average free cash flow of a negative 500. This is what concerns me right here. $4.5 billion in net income, $1.6 billion in free cash flow. Whenever, as an investor, I'm looking at something, the net income and free cash flow being drastically different, especially showing a higher net income number, net income is easier to manipulate. Now, my question about Netflix has always been this. How are they amortizing the costs on their production? Mm-hmm. I don't know what they're doing. Mo, you pull up their, Bo's actually pull up their press release on their reporting. So why don't you go through a few things?
Revenue grew 4% year over year in Q1. Let's see, average paid memberships increased 4% year over year. Let's see what else we have in here. Oh, actually, let's look at their forecast. We're on track to meet our 2023 financial objectives. So they didn't change outlook. I'm actually quite surprised that I mean, that was a big miss on usership. But besides usership, what's the stock down right now? That is quite the reaction.
So now it's rebounding.
Okay, a little bit.
It's only down 8.1%.
Yeah.
Okay, I mean, $27. It was at $295, Mo.
Typically, when you see some type of usership or subscriptions go down like that, you expect to see the full year guidance revised down.
And they revised it up?
And they just stayed the same. They expect to meet their forecast going forward. Forecast $8.2 billion in revenue, up 3% year over year, 6%. Yeah, I mean.
Now remember, guys.
But this is why we love earnings. Because it knocks these prices down for irrational reasons.
Guys, they beat by a penny. They missed by 20 million on revenue over a full quarter when they did 8 billion, and the stock got punished. This is why we like earnings season. We don't ever listen to earnings season as oh my God, guys, no company can hit every single time. If they're always beating expectations, there's some sort of fabrication of the books coming. We use this opportunity when people are over-exaggerating the downside. Okay, what we want to do is we want to look at Netflix and say, what do we think they're going to grow for the next 10, 20 years? And along the way, they're going to beat sometimes, they're going to miss sometimes, they're going to meet sometimes. But the point is to value the business based on a long-term perspective and not worrying about the quarter-to-quarter results. But we love it when the company gets butchered on the downside because of what we consider to be something negligible. Mm-hmm. So right now, the company is still down about $27. Let's look at the 8 pillars right now. It ain't pretty on Netflix. Now, the shares outstanding being up 2%, not a big deal. If you're new to the channel, the reason we look at shares outstanding is we want to make sure they are not diluting you as an investor. If they're a company like some of these companies have 60, 70% more shares than they did 5 years ago, that means that the company grew 60% and had 60% more profit. You saw zero benefit because they added 60% more shares to the company, which gets split up against 60% more shares to split everything up with. Mm-hmm. Mo, what you got over there?
So this is a comparison of different streaming companies. So I'm going to omit YouTube, the tan one. I mean, that's not really in the same realm, in my opinion. It's not having shows and this and that.
Okay.
So look at how big of a share they have. I mean, they're the biggest out there if you compare them to Disney, Amazon Prime, Disney and Hulu.
So they're the biggest individual one?
They're the biggest individual one out there if you omit YouTube. And I don't think YouTube's in the same category as them.
Yet.
Correct.
Interesting. Okay. Now, they have no data on the 5-year price of free cash flow because they have no free cash flow in the last 5 years. It's been negative. All right. PE ratio about 47. But again, guys, look at this. Let's look at this. Let's go to the income statement. In the last 3 years, they've done 9, 11, call it $12 billion in profit. In cash flow, they've done 3.4 billion in free cash flow. Why such a big difference?
Yeah. It's a huge difference.
Huge difference. Now they're only down 6.8%. They're rebounding.
Maybe it's because they're getting rid of their DVD sector.
Yeah, that's rest in peace, DVD.
I think that's why the reaction was so poor.
Can you put in the comments below the last time you think you took a DVD from Netflix DVD 16 years ago?
Mine was 2011.
So 12 years ago.
12 years ago.
Mine was probably 2006 or 2007.
I remember it was Rescue Me, the show about the firefighters in New York.
Oh, really?
Yep. That's the last DVD I got from them.
I mean, listen, you got me a DVD recently. I don't have a DVD player.
Oh, that's
Nick in our
right.
studio got me a DVD. Brofman got me a DVD the other day.
yeah.
I'm like, I don't have a DVD player.
Right.
I was just like, oh my gosh. So, I remember, put below. When was the last time you got a DVD from Netflix?
It's a great question.
Did you ever do it, Nick? Nick, how old are you? Okay, you're the same age as Mo.
Yeah. We should do a poll.
It's unbelievable, man. I look at it going, okay, now they're only down 5.8%.
Yeah.
So-
And this could all change when they do their press conference.
What time's the conference
I
call?
would imagine 4:30, but let's see.
So something's happened in between from the being down 11% to all of a sudden jumping.
Oh, this is the previous one.
All right, analyst
We'll
estimates.
find it.
Analysts expect them to make $11.66 this year, growing to $25 in 2027. If you apply a 20 multiple of this one, that's a $500 company in 2027. And assuming the analysts are right. Spoiler alert, analysts are rarely right. Look at the revenue growth. Double digits, basically, 9 to 11% a year. Great revenue growth. They're going to increase prices. And by the way, people, do not complain when they increase your price by $2 a month. I could literally go to your budget. I guarantee you go to a restaurant and order an overpriced drink, way too much. Just pay the money. It's great content. You love it. You'd think I was a Netflix shareholder. I am not. But the question always has to become, what's Netflix worth? Mo, what are you finding?
I got sidetracked. I was looking for them to talk about password sharing in their press release. I searched password and that
Oh, yeah,
one
they were
thing
doing
comes
that
up.
whole thing, weren't
Yeah,
they?
The crackdown on passwords. I can't believe that they didn't announce that one time in here.
Well, didn't they do it last time?
They did, but you think they would talk about the progression of it.
That is true.
All right, let me go back to what I was doing before I got sidetracked. All right. Let's see. Investor events today. Earnings interview. 3 p.m. Pacific time. Isn't that
That's 6 p.m.
okay? So there you go.
So 6 p.m. Eastern time.
Yep. That's when they'll talk.
By the way, I think Reed Hastings is such a tool. I think he just likes hearing himself talk. It's just, yeah, he's just I feel like he's that tech guy who thinks like, oh, I'm just speaking brilliance. Okay, that's my personal bias. Down 4.6%.
Yeah, it's coming back, baby.
It's back, baby. It was at 295, now it's at 317. Guys, are you telling me honestly that in the last 20 minutes, the last 11 minutes, the value of Netflix has changed 5%? Literally $5 billion, $7 billion swing in the last 11 minutes. This proves that stocks are not rational. They're just an auction house, and they're going to move based on on the market's emotional tirade for the week, for the month, for the year. When stocks are considered awesome, all stocks are up. When stocks are considered dead, stocks are down. Individuals, etc. Yeah. Look at Netflix's all-time high is $700 a share. Its low is $162. Wow. And that happened within how long a period of time?
Yeah, that was a very short amount of time. So that was
within 1 year.
November.
Oh no, I'm sorry.
November of 21
to May.
To May.
To June. No, sorry. To May. November to May.
Yep.
7 months. They lost 80% of their market value and now doubled from there.
Legit.
Okay. So if you're new to the channel, I want you to remember these words. We don't look at investments in stocks as these ticker symbols going up and down. We view them as buying a piece of a business. And your job is to pay the right price based on the growth of the business. That's why we have the stock analyzer tool right here. This thing was used 1.3 million times last year by our users. It is by far the most popular part. This alone justifies the software. Guys, and go sign up. It's $1.30 a day to change the way in which you look at this. Everythingmoney.com. We have people who think we should be charging $99 a month. We are not. We're charging $1.30 per day. It's a no-brainer. It's a can of Coke every single day that allows you to get this software and this community. And I guarantee people are talking about Netflix right now, and they're reporting. They're only down 3.6% now. Yep. Guys, in this time of this video.
This was down almost 10% at one point.
It's 10.3 at one point.
10.3. And
incredible.
That was 13 minutes and 30 seconds ago. Okay.
So guys, I'm gonna go in here. By the way, their ROIC blows.
Yeah, it's bad.
8 over 10 years. What's ROIC? Return on invested capital. This basically tells me, is there a moat and can they invest the money in the business at high rates of return? This shows me exactly what I thought. High streaming competition, right? Now, over the years, I think there'll be a consolidation and there'll be a lot of streaming services that go to the wayside. Definitely. And I think Netflix has a good brand for it. Yep. But the question becomes, what's that brand worth? How much do you pay for that company? That's what the stock analyzer tool does, not including the balance sheet. Says, hey, we don't know the future. Make a low, middle, and high revenue growth, profit margin, free cash flow margin, PE. Assign all this, put your desired return, and it'll tell you what price to pay for the company based on those assumptions. Yep. Very simple. So check out everythingmoney.com. Sign up now. Every month, the price is going to go up every single month from here on out. So sign up now. You get locked in your category. And if the software is $99, you're still being charged your $39 plus whatever yearly increases we do for cost of living. Yep. All right. So Mo's going to do a 10-year analysis. I'm going to do 20. I'm going to keep talking my way through it. So 20-year analysis. I'm going to be conservative and go 3, 6, and 9%. Because I'm assuming they're going to increase the cost of their services, plus get more users. Profit margin.
God, look at that free cash flow.
Let's see here. I'm going to say their profit margin is going to get better. Yeah, the free cash flow blows.
I don't even know what to put in there.
Jeez, oh, Pete. Makes my head hurt, Mo.
Yeah, I kind of took a stab at that one. I would probably have to do more research to give an accurate number, a more accurate number. And okay, all right. That cash flow.
So, Mo, what'd you do for your revenue growth numbers?
So, revenue growth, I did 6, 9, and 12. Big range, but a ton of competition coming in. They dominate the market. Middle ground, probably 9% is probably what they can do.
So, that's a 10-year analysis.
Yep.
I did a 20-year analysis. I did 3, 6, and 9. 3 is probably very, very low. But like you said, a lot of competition coming in. I'm going out 20 years. Yeah. I still think it's low. Maybe I should have done 4, 6, and 8. Let me do that. 4, 6, and 8. Okay. Profit margin, what'd you do?
I did 9, 12, and 15.
Very close to what I did. I did 10, 13, and 16.
Okay.
Okay. But let me see what I want to see what their gross margin is.
It should be high.
39.4%.
I would have expected a little bit higher.
Okay. Free cash flow margin.
I did 5, 7, and 9. And honestly, it's a shot in the dark.
I did 4, 7, and 10.
Okay.
But by the way, the question I really have on Netflix, even if all the numbers come up green, I should buy it today. The question I'm going to ask is, why is free cash flow and their profit margins so different? Yes, some people sit there and say that they're spending a lot of money and therefore it defers depreciation. So I could look at that, but I also want to know when they do amortize the costs, what do they? Because I remember once looking at it, I'm like, they amortize the cost of like 4 years, and a show is only going to be popular for a movie. Might be like, for example, Queen's Gambit. Queen's Gambit, yeah. I think I read something like new shows are amortized over some long period of time. Like that was popular for like a year and a half.
Yeah, I think we were doing it on a live stream one time, if I remember correctly.
Now I don't know the numbers. Maybe they still get a lot of viewers for that. I have no idea. Maybe. What'd you do for PE, Mo?
I did 16, 17, and 18.
So I did 14, 16, and 18 because I did 14 because of the competition. Yeah. And what'd you do for price free cash flow?
Same thing.
Same thing with me.
Yep.
Now, desired annual return, I actually did 11, 13, and 15.
Okay. I like that. I did 10, 12, and 14. But I like 11. 13,
by the way, it's only down 3% now.
Of course it is.
I'm hitting the analyze button. Here are my values I got.
These are going to be a wide range.
Wide range, guys. On the earnings side, 100 to 181. Discounted cash flow side, 41 to 113. And the reason being is how different their free cash flow was to their earnings. Go ahead, Mo.
Right here. So multiple of earnings, 121 to 253. Discounted cash flow model, 67 to 152.
Bottom line is here, guys,
It's expensive.
it's expensive. It's expensive. And by the way, people in our community disagree with me. There's one guy in the community who thinks I'm totally missing it on Netflix.
He legit says it's going to be a multi-bagger.
Yeah, he believes it's going to be, and I think it can be if you buy it at the right price. And I think it got close at 160, but not close enough for me. So I have it on my radar at 180. I don't know why I have it on my radar at 180.
I put it on there at 250. Just maybe we'll take another look at 250.
Yeah, probably when it falls to 180, you'll probably have better numbers, hopefully, from there. So, guys, if you like this, everythingmoney.com, sign up today. The price goes up every single month. Sign up now to lock in that price and get all this amazing software and the community and everything you want. Thank you very much for your time.